The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. And without objection, members of the full committee, not on the subcommittee, are authorized to participate in today's hearing. I now recognize myself for 4 minutes to give an opening statement. Ranking Member Lukemeyer, members of the subcommittee, welcome to this hearing of financial stability and systemic risk to the U.S. economy. This committee considers many important issues that impact the lives of American families and households. I would argue that no issue cuts across every district, every zip code, and impacts every American like a financial crisis. While 10 years may seem like a long time ago, it frankly feels like yesterday when it comes to the financial crisis and the Great Recession. I was here and recall vividly in 2008 when Secretary Paulson came to the House floor and told us that we literally had just a few days to save the entire American economy and financial system from total collapse. I was here as chair of the International Monetary Policy Subcommittee and a member of the Conference Committee when we drafted the Dodd-Frank Wall Street Reform Act. And I know the documentaries and movies have been made about it, but there is frankly no way to describe or fully capture the deep sinking feeling of being told that the greatest economy in the world is days away from a collapse, dragging the rest of the world with us. Today, the U.S. economy is slowing. Global trade is in a turmoil. Chinese growth is stalling. European economies are slowing with some entering recession, and a hard Brexit poses a potential shock to global markets. Big parts of Latin America are in turmoil. Oil markets are literally under attack, and I could go on. We are entering a period that may prove the first real test of the new regulatory framework put in place following the financial crisis. I fear that some actors in the economy and even in government suffer from a worrisome form of amnesia or selective memory. As they say, history may not repeat itself, but it certainly rhymes. There are echoes not just of the last financial crisis, but of elements of previous crises in the state of the economy and markets today, which cause me great concerns. There are also new emerging threats, and I question whether the administration, FSOC, or OFR and regulators are taking seriously enough the potential risk to the economy. I hope, and among those I would include high equity valuations that appear well above fundamentals, seizures in short-term funding markets, leveraged lending that burdens companies with high debts and create new complex securitization schemes, an economy meant to be the best in 50 years, propped up nearly entirely by consumers, while 40% of American households barely make ends meet and can't afford a $400 emergency expenditure. Rapid concentration of the banking sector and disappearance of community banks and minority banks, creating expanding banking deserts and exposing a growing share of the population to predatory actors and leaving many financially disenfranchised. Cyber attacks and data breaches, and again, I could go on. So I'm here, and we're here today, and I urge the regulators, FSOC, and in particular the Office of Financial Research, to invest the required resources to monitor, map, and quantify existing and emerging systemic risk. We owe it to every American family, worker, and homeowner to take an intellectually honest approach to monitoring and regulating markets to prevent the fallout of yet another financial crisis. The chair now recognizes, and I yield back the balance of my time, and the chair now recognizes the ranking member for 4 minutes for an opening statement.
Thank you, Chairman Meeks. A decade after the financial crisis, all signs are pointing towards a healthy U.S. financial system that is vastly safer and more resilient. According to Vice Chairman of Supervision Randy Quarles, every time we go through this analysis, we conclude that financial stability risks are not meaningfully above normal because there is so much capital in the banking sector. Financial institutions across the nation are injecting capital into their communities and supporting American consumers, homeowners, and business owners through increased lending. This is not to say we cannot improve. The stranglehold of regulatory burdens continues to affect financial institutions across the nation. The Trump administration has been a strong partner in easing overly burdensome regulations, and together we can do more to free up additional capital. It is our responsibility on this committee to support pro-growth policies and responsible regulations that ensure the continued safety and stability of our financial system. When the CEOs of America's largest banks testified before this committee in April, they were asked to cite the biggest threat to that their institutions faced. Many identified cybersecurity as a major threat, with Bank of America's Brian Moynihan going as far as to say, we're in effectively a war on cybersecurity. At House Financial Services Committee markup last year, I lamented that at some point there will be another major breach, and that without a comprehensive solution, our constituents will pay the price for our inaction. Fast forward a year, and we've seen numerous data breaches spanning every industry from the financial services to retailers to social media companies. Data security is a challenging and constantly evolving issue that, unfortunately, doesn't get the attention it deserves until there is yet another breach affecting millions of Americans. We need clear rules of the road surrounding data security and breach notification across the nation. Unfortunately, this committee has not had any data security hearings this year. Current data security and notification standards leave millions woefully unprotected, and the American people deserve more than a deafening silence on this critical issue. In addition to data security, I've been raising alarms with regards to the threat posed by the Financial Accounting Standards Board's CECL standard. While FASB will vigorously argue that CECL has been years in the making, members of the board have also admitted that there has not been, nor will there be, an economic impact study performed despite repeated warnings that the pro-cyclical nature of CECL could exacerbate a downturn. J.P. Morgan Chase CEO Jamie Dimon in this very committee went as far as to say CECL would put smaller institutions in a position that when a crisis hits, they will virtually have to stop lending because putting up those reserves would be too much at precisely the wrong time. It is irresponsible for Congress to stand by and allow short-sighted, hastily implemented standards to threaten the ability of our financial institutions to continue lending. I welcome today's witnesses and look forward to a robust discussion on how to support continued financial stability in the United States. With that, Mr. Chairman, I yield back.
Thank you. The gentleman yields back the balance of his time. I now recognize the gentleman from Georgia, Mr. Scott, for 1 minute.
Thank you very much, Chairman Meeks. And it's really good to have Governor Brainard and Director Fallows here with us, because this is an incredibly important and timely hearing. We find ourselves now 10 years past from the collapse of our financial system. Our economy has come a long way. I think we've done a good job. The passage of Dodd-Frank took important steps to expose the cracks in the foundation of our financial structure and mitigate the damage that was done by decades of financial recklessness. Now, as we hear from our top regulatory experts, we must evaluate not only our efforts to correct past missteps, but also we must find ways to remain vigilant against new threats to our great financial stability and our great financial industry. So I look forward to the insights of my colleagues and those of my colleagues on the subcommittee and for our distinguished panelists. Thank you, Mr. Chairman.
The gentleman's time has expired. I recognize Mr. Lukemeyer for purposes of submitting a document.
Thank you, Mr. Chairman. Ranking Member McHenry was wanting to be here and had a statement that he was going to read, but in his absence, I will just ask the committee without objection to add it to the record.
Without objection. Today, we welcome the testimony of our two witnesses. Governor Brainard. Governor Brainard took office as a member of the Board of Governors of the Federal Reserve System on June 16, 2014, to fill an unexpired term ending in January 31, 2026. Prior to her appointment to the Board of Governors, Dr. Brainard served as Undersecretary of the U.S. Department of Treasury from 2010 to 2013 and Counselor to the Secretary of the Treasury in 2009. During this time, she was the U.S. representative to the G20 Finance Deputies and G7 Deputies and was a member of the Financial Stability Board. She received the Alexander Hamilton Award for her service. Dr. Brainard was also previously Assistant and Associate Professor of Applied Economics at the Massachusetts Institute of Technology's Sloan School of Management. She received a BA with University Honors from Wesleyan University in 1983. She received an MS and a PhD in economics in 1989 from Harvard University, where she was awarded the National Science Foundation Fellowship. She's also the recipient of a White House Fellowship. Welcome, Governor Brainard. Also testifying is Director Fallows. Mr. Fallows was confirmed by the U.S. Senate and sworn in as Director of the Office of Financial Research in June 2019. He started his career by leading financial statement audits and managing a Fortune 100 corporate finance department. Subsequently, he served as a professor of law, economics, and finance, where he leveraged professional experiences in business, policy, and law with firmly grounded data analytics to build a top-ranked research program. He earned tenure in both law and economics, an endowed chair in finance, and research appointments at Stanford University and the University of California at Berkeley. Prior to joining OFR, he served as the chief economist for the U.S. House Financial Services Committee, so he's really coming back home. He's also served as a senior economist for the White House Council on Economic Advisors and contributed in leadership roles at policy research institutions, earned a doctorate degree in economics from Washington University in St. Louis, an MBA with high honors from the University of Chicago Booth School of Business, and a Bachelor of Science with distinction from the Indiana University Kelley School of Businesses. I remind the witnesses that your oral testimony today will be limited to 5 minutes, and without objection, your written statement will be made part of the record. Governor Brainard, you are now recognized for 5 minutes to give your oral presentation.
Well, thank you, Chairman Meeks, Ranking Member Luetkemeyer, members of the subcommittee. I appreciate the opportunity to be here today along with my colleague from OFR, Dino Fallows. Following the financial crisis, Congress created the FSOC and assigned financial stability responsibilities to domestic regulators. The Federal Reserve Board, in turn, created a new board committee on financial stability, which I chair, and a division of financial stability, which provides a financial stability assessment each quarter to the board and to the FOMC. And I just want to acknowledge Andreas Leonard, who has led that division. We now publish a financial stability report semi-annually in order to increase transparency and accountability, and I brought a copy today. Because the buildup of financial imbalances in good economic times has the potential to lead to disruptions in credit that can amplify a subsequent downturn, we assess financial vulnerabilities as well as mitigants that build resilience. Let me briefly run through these. Overall, household borrowing has come down in recent years and is now growing more slowly than the economy overall. While much of the increase before the crisis reflected borrowing that proved unsustainable, more recently it's been concentrated among households with stronger credit profiles. In addition, there has been an increase in student debt in recent years, which deserves attention. Second, far-reaching reforms have made the regulated financial sector more resilient. Insurers appear generally well-capitalized and broker-dealers have lower leverage. Banks increase capital buffers following the crisis, although the ratio of capital relative to risk assets at the largest banks has moved down somewhat as payouts have exceeded earnings over the past couple of years. Financial reforms have also importantly reduced funding risks. Large banks subject to liquidity regulation have stronger liquidity buffers and are less reliant on unstable short-term wholesale funding. There are, however, two areas that I'm monitoring closely. First, a range of asset prices are high relative to historical benchmarks. Relative to Treasury yields, spreads on high-yield corporate bonds remain somewhat narrow. Relative to historical norms, spreads on leveraged loans remain in the bottom half of their range since the crisis, and capitalization rates on commercial real estate have been low. Declines in those valuations could make it more challenging for firms to obtain or extend financing, which could be amplified by high levels of risky corporate debt, and that's the second area of note. Business borrowing has risen more rapidly than GDP for much of the current expansion and now sits near its historical peak. It appears that firms with high leverage, high interest expense ratios, and low earnings and cash holdings have been increasing their debt loads the most. While the share of high-yield bonds rated deep junk has stayed well below the financial crisis peak, within the investment-grade segment, half of those corporate bonds are now rated at the lowest level, and that's a near record. Widespread downgrades of those low-rated investment-grade bonds to speculative-grade ratings could induce some investors to sell them rapidly, and this bears watching, since total assets under management in bond mutual funds have more than doubled in the past decade, and they now hold about 1/10 of the corporate bond market. In addition, net issuance of leveraged loans grew rapidly last year. The total is now over $1 trillion, although the pace of issuance has slowed as the interest rate environment has shifted. Covenants issued for the loans issued in the last few years have weakened notably, and they often include terms that increase opacity and risk. A substantial share of those are packaged in CLOs, and many large banks originate leveraged loans with an intent to distribute. While the direct exposures of the banking system in the form of loan portfolios and warehousing exposures are being monitored, there are indirect exposures, including through investments in CLOs and credit lines, and of course, non-bank exposures are hard to monitor. Overall, corporate credit conditions have been favorable. However, history points to the risk that excesses in corporate debt markets could amplify negative shocks. That brings me to the final point, recognizing we must be especially vigilant to fortify financial system resilience in good times. Our toolkit includes a countercyclical capital buffer that is intended to be on top of strong through-the-cycle requirements. The CCYB is simple, predictable, and slow-moving. It applies equally across all large banks. The criteria for implementing it were released in September 2016. The board voted to set it at 0 earlier this year, but many other jurisdictions have raised their countercyclical buffers above 0. Thank you. I look forward to any questions.
Now I yield 5 minutes to Mr. Fallows for your oral testimony.
Chairman Meeks, Ranking Member Lukemeyer, and members of your subcommittee, thank you for inviting my testimony on behalf of our Office of Financial Research. I'm honored to appear with the Governor and look forward to discussing the productive role that OFR plays in our government's financial stability framework. Throughout my career, I enjoyed developing firmly grounded perspectives on important financial and economic matters, and I have especially enjoyed doing so through public service at the President's Council of Economic Advisors, this committee, and now as director of our office. Before starting my testimony, I want to recognize our staff. Prior to my appointment, our office extensively re-examined its mission, culture, and structure. Throughout, our staff never let go of a mission that they and I support. I am grateful to each and every one of you for your dedicated service as individuals and a team. I begin my testimony today by acknowledging you all. My priority and commitment to them is a safe, collegial, and fulfilling workplace so that they can thrive personally and professionally by furthering our important mission of serving FSOC and its member agencies. When it comes to economic opportunity, our United States stands as the world's leader. A resilient financial sector is vital to every American. While the great financial crisis is sometimes characterized as a perfect storm, credible warnings were available. For example, the President's economic report in 2006 highlighted the importance of financial services for upward mobility. In doing so, it also called on regulators to, quote, mitigate the likelihood of systemic events. Despite their accessibility and timeliness, such warnings could not mitigate, let alone stop, the crisis that was to come. Reflecting on this history, a prominent economist rejected calls for increased regulation of an already heavily regulated sector. Instead, he highlighted opportunities for data analysis and monitors to increase transparency for interinstitution exposures and concentrations of risk. OFR was established to increase the likelihood that future warnings will be more credible when grounded on economic fundamentals and informed by high-quality data and careful research. OFR supports FSOC and its member agencies with data and research services that work toward this important end. Our office's latest annual report to Congress was published in November 2018. It saw financial stability risks in the medium range while indicating relatively high market and cybersecurity risks. Credit risk appeared moderate overall, with increased risk from leveraged lending tempered somewhat by lower risk from consumer credit. Risk from solvency and leverage remain low in general, while funding and liquidity risk was low overall. However, these risks can change quickly. Cybersecurity risks continue to warrant attention. Our office first discussed risks from cybersecurity in the inaugural 2012 annual report. Our 2018 annual report also highlights how network analysis could provide increased transparency for cyber risks. Our office expects publication of its 2019 annual report later this year. That report remains a work in progress, so I cannot speak to details. Based on currently available data, however, our overall risk assessment will remain in the medium range. American economic opportunity is the envy of the world. The OFR plays an important role in fortifying financial stability for the world's greatest economy. I am honored to lead our office and proud of our good people who wake up every day to advance its important mission. Thank you for your invitation to testify. I look forward to your questions.
Thank you. The gentleman yields back the balance of his time, and I now recognize myself for 5 minutes for questions. Let me start with you, Governor Brainard. The Fed has done a rapid pivot to cutting rates, and now, just last week, and I asked this question yesterday to the members of the SEC Commission, they are intervening aggressively in the repo market, short-term lending. And I get those echoes, as I talked about in my opening statement, about I don't ever want to be back where we were in 2008 when Secretary Paulson. And then I look at what's happening with Brexit and the situations with China slowing down, et cetera. So you mentioned in your opening that one of the key risks you worry about, I think I heard leverage lending. Would you also expand on leverage lending, why that may be a potential risk, and any other factors that you think that we should be really paying attention to?
Thank you for your question. So first of all, with regard to leverage lending, we really saw very rapid increases in leverage lending over the past several years. Although some of that has slowed as the interest rate environment has made bond issuance, again, more attractive. The thing that is notable, apart from the very large increase in leverage loan issuance that we saw, is just that the covenants on those leverage loans have weakened quite notably relative to what they would have looked like historically, and there are features that make them less secure, more opaque for some of the investors. Now, they are being securitized, many of them, in CLO structures. And so what's important, I think, going forward is to be able to have as much visibility as we can into those structures and who is holding those loans through those structures. We look at banking system exposures, but of course there's a very large component, which is non-bank, that I think bears attention. I don't know if you wanted me to also turn to repo,
Yes,
but I'm happy to
please.
do that. So just to take a brief moment to separate how the FOMC looked at the economy. So with the interest rate decision, the federal funds rate decision that was made at the September FOMC, that was really a traditional kind of monetary policy lens. We're looking at the economy, looking at downside risks from trade policy uncertainty, in particular from slowing growth abroad in an environment of muted inflation. The committee, or at least in my view, was wise to take out some insurance against downside risks to the economy. What is separate from that is the pipes of the short-term money markets, which is really what we're talking about in the repo markets. And there, what we saw was that a number of events, there was a confluence of both increased supply of Treasury securities that needed to be funded, at the same time as we also had some of the suppliers of cash in that market withdrawing because they had large corporate tax payments that they were taking care of. So it was a confluence of factors that led to an imbalance in supply and demand in the pipes of the system. I would really say that the New York Fed is very focused. They've been providing ample operations to relieve those temporary frictions, but the operations that they undertook were not for purposes of monetary policy. It was to address those technical issues in the pipes in the system.
Thank you very much. And let me ask the director, I've noticed that you had staff reduction of more than 43%, a budget cut of 25%. So I'm really concerned about OFR having the ability to have the personnel that's necessary to do what you were charged to do. So can you tell us how you are committed to and how you plan on rebuilding the OFR team to ensure that it's clearly focused on the monitoring and mapping and qualifying systemic risk wherever it might be, so regulators are well equipped to do their work?
Thank you for your question, Chairman. I just lost my name tag, but you know who I am. We are in the process right now of, and thank you for your meeting yesterday, our head count right now is in the neighborhood of 100 employees at our shop. We are building, we are recruiting vigorously. We are interviewing, and we are retaining the people that we are bringing on. We're making good progress on that. In addition, with our staff, I have a mission which is well on its way to meet with every staff member in our building. I host lunches twice a week with our staff members. I want to hear everything that is going on within our organization, and I think going forward, as we fill out that team, it will not only be a larger team, but it'll be a more collegial and effective team.
Thank you. My time has expired, and I yield 5 minutes to the ranking member, Mr. Lukemeyer.
Thank you, Mr. Chairman. Mr. Fallows, you and I had a conversation last week, I believe, with regards to your ability to do a study that would give us some idea of the impact of CECL. And I think you indicated to me that you need to have some sort of directive from one of the members of the FSOC or FSOC itself. Is that correct?
That is correct, sir.
So exactly what is the process to be able to get a study? So in other words, if Governor Brainard asked you to do that today, would that be sufficient?
It is the members of the FSOC would make that decision, and you know they're regularly briefed on issues like this. But I understand that has not come up in our FSOC meetings.
What would the typical study look like? What are the factors you would examine?
On CECL per se?
You look at the macroeconomic effect of it. Is that what you do, I assume?
Sure. Yeah. We, you know, whether it's countercyclical, pro-cyclical, those sort of issues could come up. You know,
you take into account the other industry reports that I've seen that show the amount of money they're going to have to add to additional reserves, the costs that would incur that have to be passed on to consumers. All that would be part of it, I assume.
The cost-benefit analysis would certainly be in that report. Yes.
Okay. Thank you. Governor Brainard, I've discussed this issue with every single member of the Federal Reserve Board. I think I've even discussed it with you in the past. This is obviously something that's very concerning to me because of the impact I think it could have on our economy, on the financial service industry, on our consumers' ability to have affordable or access to affordable home loans. And so this is really, to me, a really big deal. You know, you've heard Mr. Fallows' concern, and I think you know enough about CECL to be willing to do. Would you be willing to go to your board members and ask them to do a study for us?
Well, thank you, Ranking Member Lukemeyer. So first, I will say that I have heard from many banks that they don't understand, especially smaller banks, how CECL might impact them. Now, of course, CECL is a standard that's put in place by an independent standard-setting body, so it's really something that we are simply obligated to accept. It's not something that we make determinations on.
Yeah, I mean, I apologize for interrupting, Governor, but now you're going to have to enforce this. Now, if you have to enforce a rule that's going to be detrimental to our economy, to the industry that you oversee, don't you think you ought to push back on that a little bit? And let me, before you answer that, let me read you what, I don't normally put credence in any of these political rags around here, but this one was of last Thursday, was the Hill, is quoting Chairman Powell directly. And the chairman said in response to a question, the Fed has no role in formulation of trade policy, but we do take into account anything that could materially affect the economy relative to our employment and inflation goals. When you look at the impact of this, that has direct and material effect on employment and inflationary goals. You're not going to consider that?
So just to continue, so there have been a number of quantitative studies that have been undertaken. Of course, we have looked at those very carefully. They do not conclusively suggest that there would be a negative impact. That said, I am not, as you know, our representative to FSOC. The chairman
Yeah, but
is.
you're on the board, Governor, and you have an input. I've got files from the credit union folks. I've got the testimony from the bankers who were in this committee not too long ago of billions and billions of additional dollars they're going to have to reserve. Those costs have to be passed on. That should be a concern.
Absolutely, and to the extent that FSOC wants to ask OFR to do a study, that's certainly something.
Would you be willing to help push for that?
I would certainly be happy to convey these concerns to the chair in his role as our representative.
Yesterday I relayed a story, an analogy of what's going on here. And the analogy goes like this. A few months ago, we celebrated the 50th anniversary of the putting a man on the moon. Imagine yourself in a lunar module on top of a rocket. Knowing the last rocket, i.e. mark to market, that was done without a study of cost-benefit analysis, blew up on the launching pad. And now you're sitting on top of another rocket called CECL that hasn't had a cost-benefit analysis or study on it. Would you be willing to light that rocket?
So again, I think it's very important to understand.
Would you be willing to light that rocket without a study or a cost-benefit analysis, knowing the last one just blew up?
So I think that there have been a fair amount of quantitative studies done, and of course, I'm always
You're the only one that would be willing to sit on that rocket and light it and let it go. Everybody else, every regulator I've talked to said, no way. They need to be sure that it's tested, to be sure that you're willing to put the economy at risk without a cost-benefit analysis study that this gentleman is ready to do. That is not very responsible, Governor. Thank you.
Gentleman's time has expired. I now recognize the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you, Chairman. Governor Brainard, let me start with you. In recent weeks, the Fed has had to take extraordinary steps to maintain liquidity in short-term debt markets and repo markets, including the actions of the New York Fed earlier this week. It injected almost $50 billion for overnight repurchase agreements, or repo, to relieve funding pressure in money markets. The last time that this happened was back in 2008, as you probably know, during the financial crisis. Why is this happening now?
Well, thank you for your question. We certainly recognize that we have important pipes in the short-term money markets, which the repo market is part of, and we want to make sure there's ample liquidity so that we don't see these kinds of frictions. And it's important to understand exactly where these frictions are arising. Now, we did anticipate, market participants did anticipate that there would be increased need for repo.
Well, let me ask you this as we go on. What are the risks? That's what I'm after. What are the risks to our financial institutions that they may become unwilling to lend to each other, as happened in 2008?
Yeah, so From what our market discussions and surveys are able to tell, this is a very different episode, a different set of frictions than in 2007, 2008. 2007, 2008, we had counterparties pulling away from each other because there was concerns about the underlying quality of collateral and the creditworthiness of those counterparties. Today, we're in a different environment, and we believe that what we saw was a simple imbalance between those who are willing to supply and those who needed to finance repo. I believe that we have said, the committee has said, that we are operating in an ample reserves regime, and it may simply be that we are close to the lowest level of reserves that are necessary for the conduct of monetary policy. But the kind of intervention that the New York Fed took, that is a pretty standard open market operation. And my own inclination would be to look at mechanisms like allowing the balance sheet to continue organic growth in order to make sure there is enough reserves in the system so we don't see those kinds of frictions.
Okay, now, all of this is happening at the same time that there is an upcoming transition from LIBOR to what could be SOFR. Now, I think that this poses one of the greatest potential disruptions to our financial system ever. And this is why. Uncertainty. It has a large part to play in how smoothly this transition plays out. We're talking about $400 trillion in contracts worldwide. $200 trillion in contracts here in this massive change between these benchmark rates. And so we're after a smooth transition in terms of how this new reference rate will perform, and particularly with what we call these transition legacy contracts. So, are you concerned about this volatility and how it may add to the uncertainty associated with this rate change? This is a big issue. Can you explain it to us and understand and share with me and the audience and C-SPAN how serious this issue is?
Well, thank you. So I think the transition away from the reference rate that was shown to be subject to manipulation and is becoming increasingly fragile as fewer participants provide input into that rate. That transition to a more market-based rate that is going to be more resilient and not subject to manipulation is a very important transition. And it is a transition that I think we should all be paying a lot of attention to, and financial institutions prime among those who should be paying attention.
Thank you. The gentleman's time has expired. I now recognize the gentleman from Florida, Mr. Posey, for 5 minutes.
Thank you very much, Mr. Chairman. I appreciate your and the ranking member's leadership in holding this hearing today. We're here today to examine the role of our regulatory community in monitoring and ameliorating systemic stability of our financial institutions. I welcome the witnesses and thank them both for being here today. The current framework for responding to systemic risk in our financial system centers on the Financial Stability Oversight Council, or FSOC as we refer to it, role in identifying and designating non-bank financial companies as posing systemic risk. Identifying such a company as posing this kind of risk makes the company subject to enhanced supervision by the Federal Reserve Board. We recall that one of the big interventions during the financial crisis recently was rescuing the company AIG, the American International Group. Assuming FSOC had been in place prior to the crisis, can you give the committee and the public a description of how FSOC would have worked to prevent the outcome we had with AIG? Governor, you can go first, and Director.
So I think the intention of designation, again, I'm not a member of FSOC, so I can't speak to the designation process, but I think the intention certainly of that designation authority was to be able to take institutions that were not supervised banks and subject them to consolidated supervision across all of their activities. And so, of course, for institutions that had a lot of derivatives exposures that were not well risk managed and that the company was not prepared to make good on in periods of stress, that kind of designation authority would have shown the full scope of activity to the supervisors and put in place resolution planning, liquidity requirements, capital buffers against the full scope of activities as opposed to the more narrow pieces that were under regulation. But again, I'm currently not on the FSOC, so I can't speak to the current system.
Thank you. Director Falaschetti?
Sure, and thank you for your question. The council is pursuing an activities-based approach to designations for non-bank financial determinations. And what this will do, the benefits that this brings, it'll enhance analytical rigor and transparency in the process that the council pursues. And some of the activities or the characterizations of these activities are complex or opaque activities, those conducted without effective risk management practices, those that are significantly correlated with other financial products, or either highly correlated or significant and widespread. And
Yeah, I guess more specifically, more specifically, how would they have identified AIG's threat to systemic stability? What metrics would have disclosed this threat? How would it be different today?
The activities that I outlined here, we would dive in. Excuse me. We would work through each of those and size up the any particular firm that might be subject to this consideration.
So you think now that FSOC would do the job that the regulators did not do before?
Yes, and again, the transparency and the accountability of this proposal is what is attractive.
Give me an example of how they would identify a derivative as being dangerous.
With these, I'm sorry. With this list of the proposed guidance, you have complex. Measure it up. Is it complex? What is the degree of opaqueness in this market? Is there effective risk management? Each of these considerations would guide the FSOC.
But they should have had those same considerations before, shouldn't they?
They should have, but this wasn't the way that it used to be implemented. That the conversation went, and when you designate a firm, one firm, and you've got some other firms in the same sector that.
Okay. Gentleman's time has expired. I now recognize the gentlewoman from New York, Ms. Velasquez, for 5 minutes.
Thank you, Mr. Chairman. Governor Brainard, as you know, earlier this summer, there was a cybersecurity breach at Capital One. At the time of the event, Capital One relied on Amazon Web Services for its cloud storage needs and has continued to rely on AWS even following the incident. In its 2018 annual report, the FSOC specifically highlights the growing reliance of financial institutions on third-party service providers like Amazon as creating risks to the financial system. Can you explain the risks that are created by banks' increasing dependence on third-party services providers for their data storage needs?
Well, Well, thank you for the question. So a lot of financial institutions, like large institutions that have tremendous needs for processing data across the economy, and including government entities, are looking at questions about how much of their infrastructure, how much of their core systems versus their software services should they hold in-house, on-premise, or move to cloud providers. So this is the beginning or the middle of a trend that I think will continue. What authorities we have as bank supervisors and examiners come to us through the Bank Service Company Act, which do provide the FIFI Act, the bank regulators, some ability under circumstances where providers are significant providers to examine some of the third-party providers. There's also a lot of work on this issue because of the concentration of some of the cloud provision in international fora. So this is also an area that we're looking at in the Financial Stability Board internationally, but it's certainly something that we're very focused on.
So is it fair to say that an event like the one that occurred at Capital One earlier this summer has the potential to pose a serious threat to the financial system?
So the particulars of that breach have to do with both the institution as well as its cloud migration. I think we do recognize that migrating to the cloud mitigates some risks, adds other risks, and so we need to hold our institutions accountable for making that risk assessment in a very well-informed way and taking that migration very seriously.
Thank you. Director Falasheri, the OFR's 2018 report identifies cybersecurity as a continuing concern. Can you explain how the potential impacts of cyber risks are compounded by banks' own operational practices?
Thank you for that question. We are, I would put the cloud question with cyber risk. What we're really worried about here are the interconnections. If we have a cyber attack on a particular organization, that organization has channels of transmission of that risk to other organizations. And our researchers are developing a network analysis that would help bring transparency to understand, okay, well, if this particular organization finds itself in difficulty from a cyber attack, who else is downstream, and to share that information with FSOC to take appropriate action.
Thank you. This question is for both of you. While crypto assets remain relatively small, they are growing fast in size, numbers, adoption, and applications. As you are both aware, earlier this year we held a hearing on Libra, which is the cryptocurrency being developed by Facebook and its association members. What risks to financial stability does the Libra cryptocurrency pose? Governor, let's start with you.
Yeah, thank you. So I think the advent of Libra really sharpened the set of questions that regulators, officials need to think about in terms of stable coins, their potential adoption for payments. What does this mean in terms of, if you're a consumer, your social media platform having information on payments, will they keep your data private? Will they keep it secure? For regulators such as the Fed, the potential for this to be across many jurisdictions and the potential to have very incomplete regulatory authorities.
Yes or no answer, do you have the regulatory authority that you need to monitor this
The gentlelady's time has expired.
It was to you, the governor.
I now recognize the gentleman from North Carolina, the ranking member of the committee, Mr. McHenry, for 5 minutes.
Well, I appreciate the chairman for yielding. So, Governor, let's go to this question of cybersecurity. On balance, a well-regulated migration to the cloud can be a better decision for financial institutions. Is that correct in your view and the Fed's view?
I think each individual institution is going to make that assessment. They just need to do it.
I'm
with a
asking
lot
your
of risk
assessment
taking.
on it.
It can be.
It can be. Is that, Director, is that your view in terms of research?
I'm sorry, can you repeat the question?
Never mind, we'll just keep moving. So, Governor, about cyber. Currently, we don't have any reportage from the Fed to this committee and policymakers on the Hill about what your institution is doing to protect itself from cyber threats. Do you see any reason why the Fed shouldn't report this information to policymakers on the Hill?
I think this is a critically important issue. We do, of course, get assessed at the federal level, like any other federal agency. But of course, we agree this is critically important.
And you have a strong IG that reviews this too, so we do get independent reportage. So about the repo market, back to the chairman's question, I think there's real interest on both sides of the aisle about what happened in the repo market. And what you reported is very similar to what I've read in the FT and the Wall Street Journal. So in terms of your outline, it's very clear. The question is, what does it mean? And what does it mean for average, everyday investors? So just distill that.
So because we do have the ability to provide that liquidity at moments like this, it's a very standard set of procedures. At the moment, it really doesn't have implications. But going forward, it does pose questions about whether reserves in the system do need to be allowed to grow again, and whether there is that demand for reserves to make sure that we don't see this kind of volatility that is very disruptive in
So what does it mean,
short-term financing
reserves?
markets.
What does that effectively mean?
So it may mean, my inclination is we are in an ample reserves regime. That's the monetary framework that the committee adopted. Ample reserves means there's enough reserves in the system that you don't see this kind of short-term volatility. So one of the things that it may mean.
So the assumption is because of ample reserves, this shouldn't happen. Okay, so this is then the question for the Fed, which is how long are we going to continue open market operations?
So I think for the foreseeable future, the New York Fed has provided sufficient liquidity, and they've done it on a term basis for anticipating needs at quarter ends, which tend to be periods of higher demand.
And we're
But
coming
yes,
to
I think
quarter end as well,
and-
right? So this is a quirk that is happening outside of that tighter time frame. Okay, so let's move on to China. The assessment here, what we know from public reportage is the reserve ratio was reduced by 50 basis points. This basically injects $126 billion into Chinese institutions. What does that mean? What's your assessment? This signifies an economic slowdown in China, clearly, and there's ramifications for that. We're seeing outflows of capital to the United States in recent weeks especially. Could such a slowdown affect the U.S. economy, and how?
So China's a really important part of the global economy. We are in a global economy. Many of our firms are interacting on international markets. China affects the economies that it trades with, commodity producers. Export from Germany have gone down. So yes, when China slows, it is a drag on the global economy, and it can hurt our producers here.
So what's your view on modern monetary theory?
So modern monetary theory really goes to the fiscal kind of framework that the country operates in, which is outside of our monetary policy frameworks. I will say.
But the intent with modern monetary theory is to control inflation through taxation rather than the Federal Reserve interest rate setting. So what's your view of modern monetary theory?
So my general sense is we have a well-tested, effective institutional framework for monetary policy, separate from fiscal policy. Currently, that's worked well for us over many decades. And my general assessment is that this is also an institutional framework that's worked pretty well around the world.
What's your view of the economy right now? Is the economy strong?
So when you look at the economy, you see strong consumers, You see continued pretty strong labor market with payrolls continuing to grow above the pace needed to absorb
Wages
new
growing.
entrants. You see wages growing above the rate of inflation, but you also see business sitting on the sidelines, CapEx flattening out, a lot of uncertainty out there. And of course, you see a global environment that you alluded to earlier, which could be a drag on our economy. So we're watching that very closely. In my own view, it poses downside risks, and that's why it made sense to soften the path of monetary policy.
Thank you, Mr.
The
Chairman.
gentleman's time has expired. I now recognize the gentleman from Illinois, Mr. Forster, for 5 minutes.
Thank you, Mr. Chair, and thank you to our witnesses here. Governor Brainard, the Capital One hack, was essentially a failure by, I believe, the firm itself, what's called a server-side request forgery, due to a misconfigured firewall, and not the cloud provider. And so this is an example of something that I think will continue forever. If a company does something dumb, whether they're in the cloud or not, that's a problem. There's a second class of things having to do with if you're completely dependent on one cloud provider and that cloud provider goes down. And so my question here, has the Fed specifically looked at this risk, and is there a merit to potentially requiring major financial firms to connect to more than one cloud provider so they can fail over to the second one in the case that one of them goes down? Has that been looked at both from the cost point of view and the feasibility point of view?
Thank you for your question. I think the principle of resiliency through redundancy is well established, particularly for systemic infrastructures. Certainly, there's work internationally that we're participating in, thinking about precisely this question that you raise about the ability to fail over. And I think there's some technologies that are out there or developing that would provide mechanisms for being able to do so that that lock-in is less of a risk.
And there's also the possibility of a completely correlated risk. For example, last year's Spectre and Meltdown bugs that allowed processors to see into essentially arbitrary memory locations called into question the whole concept of cloud computing and having multiple processes, potentially from other companies working on the same processor. But moreover, that bug, it's my understanding, applied to a range of hardware so that it worked, the bug applied to Intel x86 and ARM processors and IBM Power processors and everything. So there was no, even using different hardware did not protect you from that bug. And so what you saw there was a correlated risk where the one bug can be uncovered that applies to all cloud hardware as well as all non-cloud hardware. So how do you evaluate that correlated risk, and how do you defend the financial system against it?
So I certainly believe there are a variety of different ways that we could see threats to the systems of our financial institutions, whether they are in the cloud or whether they are on-premise or whether they are in their private cloud. So it's a constantly evolving, I think, set of dynamic challenges, and the best that we can do is seek to understand them ourselves. And
well, do you believe that the Fed examiners have enough technical horsepower to identify this kind of risk? It's you're talking about very skilled people who could earn big paychecks elsewhere in industry.
So my own perspective has been to fortify our own internal technical resources, and that's going to be a continued area of high priority for me.
Okay, let's say another completely unrelated question is that many of your positive comments about financial stability had to do with the relative quality of debt ratings. And all of these debt ratings still rely on the issuer pays model, which was pointed to by many people as one of the core failings that led to the financial crisis. And to my belief, it's not really been solved. Are there solutions to this that are potentially workable that maybe Congress should start thinking about?
So it's a good question. I know there are a variety of initiatives that have been kind of looked at in this space. There's not one in particular that I would say I would put my strong kind of support against. But as was true going into the crisis, we also wouldn't want institutions to be overly reliant on a set of ratings alone. We want institutions to be making risk assessments using additional mechanisms.
Yeah, but even in your comments on financial stability, you were using, implicitly the ratings of debt instruments.
So obviously, when we do our aggregate assessments, to some degree, we're looking at patterns in the overall data, so we need public sources of data to do that. But then we drill down. So to the extent that we have individual or a multiplicity of balance sheets, we do some drilling down, and we describe that more qualitatively, particularly when it relies on data sources that are not public.
And are you worried about the rebirth of mortgage-backed securities, which has been the subject of several?
Gentleman's time has expired.
Thank you.
I now recognize the gentleman from Kentucky, Mr. Barr, for 5 minutes.
Thank you, Mr. Chairman, and Director Fallows and Governor Brainard. Thank you for your service and for your valuable insights on financial stability today. I want to drill down a little bit on this issue of leveraged lending, and I want to draw an important distinction between credit risk and systemic risk. Credit risk, of course, is the cost of doing business for investors. There's a possibility, of course, that a borrower might default. That possibility is priced into the product, and investors are aware of potential downsides. But just because a product is risky does not mean it is a contagion that will spread to other parts of the financial system and bring down our economy. That's what systemic risk is. Leveraged loans are, of course, not without risk, but that's the idea. Risk is how investors earn returns and how businesses access credit to finance their operations. During yesterday's full committee hearing, SEC Chairman Clayton testified that he believes leveraged lending does not pose a systemic threat. Other regulators, including the chairman of the Fed and vice chairman of supervision, have made similar statements. However, many of my Democrat colleagues maintain that leveraged lending poses a systemic threat to our financial system. At approximately $1.2 trillion, leveraged loans represent only about 4% of the entire U.S. fixed income market. That's compared to $15.2 trillion in non-financial business debt like commercial loans and bonds, $10.3 trillion in household mortgage debt, $4 trillion in consumer debt, and $1.6 trillion in student loan debt. Director Fallows, can you speak to this distinction between credit risk and systemic risk in reference to leveraged lending? And can you also talk about the features of CLOs? Namely that these are long-only, non-mark-to-market, term-financed, actively managed funds in senior-secured commercial and industrial loans. And can you speak to whether or not those features of CLOs enhance financial stability or undermine it?
Well, thank you for the question, and I know you've done a lot of good work on this particular issue. Before I was confirmed, the FSOC had this issue before them. This was in March of 2019. And there was a really nice presentation during that FSOC meeting. On one side, we had an OFR economist, and we also had an economist from the Federal Reserve. And each one of them took the different sides of the balance sheet, which I think is where you're going with this. On the left-hand side, you're looking at really risky assets, and if that's the only thing that you're looking at, you're going to say, hey, you know what, this is a lot of trouble. But on the right-hand side, what you heard from this brief to the FSOC is exactly what you're alluding to, is that there's patient capital on the right-hand side. And so patient capital doesn't run at a sign of smoke, and the tiering of the losses sort of locks people in to mitigate that risk.
Governor Brainard, a question for you on this. With a collateralized loan obligation, the risk of loss is held mostly by insurance companies, asset management firms, hedge funds, other similar non-banks that are better able to absorb it. If there are larger than expected losses, they won't impair the banking system or banks' critical role in managing the payment system and credit availability that is crucial for a healthy economy. AAA CLOs are empirically risk-free, not low risk, but risk-free, based on their structure and absence of defaults in a 30-year history of the market. I'm just talking about the AAA tranche here. Zero defaults, zero impairments in the 30-year history of the market. So it does seem a bit misplaced to point to AAA CLOs as a source of concern. Does the Fed agree or disagree that having bonds, that having banks fund loans indirectly through owning AAA CLO bonds, which have a 35 to 45% loss absorption cushion below them and have never been impaired in the 30-year history of the market, is better and safer for the banking system than having banks fund loans directly and taking 100% of that credit risk?
So thank you. I think you're making very important distinctions, and of course, we do think very much about individual assets and the credit risk embodied in them quite differently than we try to track what might happen if a number of investors behave the same way under stress circumstances. And so that's really the kind of spirit of our financial stability work, is to think about what might happen during very stressed conditions that might lead what looks like a set of very secure investments, investors to behave in a kind of run dynamic, in a fire sales dynamic. So for instance, there are a large amount of leveraged loans sitting in loan funds. And we had a little mini stress test event back in the fourth quarter last year. And what we saw is that there was a lot of redemptions in those funds, which worked pretty well. On the other side of that, we had a lot of CLOs picking up those leveraged loans that were coming out of those structures.
Gentleman's time has expired.
Thank you.
I now recognize the gentleman from Florida, Mr. Lawson, for 5 minutes.
Thank you. Good morning and welcome to the committee. Thank you, Mr. Chairman, and the ranking member for today's comment. My question to both of you is centered around, and it's important, what impact does a trade war have on the health of our economy, and what will the long-term effects be on our financial market?
As noted, we addressed this in our 2018, our most recent annual report, and there is some uncertainty surrounding trade policy. That said, our economy continues to be strong, and OFR will continue. Our job is really to monitor sort of, these kind of events on the stability of our financial sector, and that's going. That is continually ongoing in our shop.
So thank you for the question. We, in terms of our monetary policy assessments of the economy, one of the factors that I think you'll see cropping up most frequently in the minutes of our meetings, for instance, is that we are hearing from business contacts all over the country in all of our districts, from business who are saying that the uncertainty about the rules of the game on trade are really leading them to sit by the sidelines. They are rethinking supply chains, global supply chains, but they're not quite sure how to reconfigure them. And so we do see it in the business investment numbers. We do see it in CapEx in particular, which has flatlined and looks like it's softening further. We have some of our independent research that was recently released suggests that trade policy uncertainty itself, just the uncertainty about what trade policy will look like, does actually have a material negative impact on the health of the economy. And so it's something that I think has been one of those prominent downside risks that has led the committee to reassess the path of the economy.
And one of the reasons why I asked that question is I sit also on the Agricultural Committee. And we realize all of the problems that we have with a lot of our farmers, what's going on with China and so forth. And from a budgetary standpoint, we have been subsidizing the farmers in this country on a regular basis either because of natural disasters and because of the downturn in the economy. And so I wanted you all to, and I know you probably confront this from time to time in your deliberation, can you comment on what effects it's having on the economy with our agricultural industry in the U.S.?
Yeah, so we talk a lot about the pain that's being felt in the farm economy in the FOMC. Of course, we have a lot of agriculture represented on our boards of directors at our reserve banks, and I certainly hear a lot as I travel around the country about just how difficult conditions have been. Trade is clearly a big piece of that picture, but as you know, for some parts of the country, weather has been a huge factor as well. And so it is something that I think has been prominent in our discussions.
You care to comment?
Sure. You know, the OFR has a very narrow remit, and so you know, with trade, you look at we have a monitor for market risk, and that would fall under that market risk monitor. And our researchers would dig down and consider, okay, well, you know, what are the growth effects of this issue, and how might that impact our financial sector, and we would communicate that to the FSOC principals.
Okay, thank you. Mr. Chairman, I yield back. I yield back.
Gentleman yields back. I now recognize the gentleman from Colorado, Mr. Tipton, for 5 minutes.
Thank you, Mr. Chairman. And Director Fallows, wanted to be able to give you an opportunity to be able to talk about some of the LIBOR transition that's been going on. What is OFR looking at? What type of plans do you have in terms of some of that transition to SOFR?
Thank you for the question. The LIBOR transition is, in a lot of people's eyes, a critical risk. I would put it under contracting risk. You could think of Brexit as a contracting risk issue as well. If everything works smoothly, great, but recontracting at such large scales is very difficult. And if I recall my figures correctly, you know, the notional value of contracts that are now indexed to LIBOR are an order of magnitude higher than for SOFR. So we have 2 years to pull the switch on this, and people are developing fallback language. But you know, as you and I discussed in your office, my fallback language might not jibe with your fallback language, and so you know, how long does that process take place, and where does that settle? There's a lot of work to be done there, and we're monitoring the potential implications for systemic risk from that issue.
It does create somewhat of a challenge because some of the LIBOR securities cannot be amended without 100% investor consent. That's got to be creating some real challenges for a transition.
Oh, absolutely.
And did you have a comment on that, Governor Brainard?
No, I entirely agree with Director Fallows' comments there. It's a very big issue. ISDA obviously has put out some protocols. You know, the more sophisticated players in this space are recontracting, but there's a lot of frictions in doing that, as you say, which creates risk.
Well, Governor Brainard, while I've got you there, you mentioned earlier in testimony regarding LIBOR, financial institutions should be paying attention. Particular interest to me are some of our smaller banks, our regional banks as well, concerned whether or not they're going to be less prepared potentially for that transition. Do you have any comments?
So we always try to provide as much technical assistance and education as we can through our examiner kind of interactions with our smaller institutions, recognizing that they don't have the same kind of resources. They don't, in many cases, they may not have the same kinds of exposures, but we want to make sure that they are well equipped to deal with these transitions. So we try to do that through our educational materials, through examinations, discussions, and of course we do that in conjunction with the other banking agencies through the FIFIAC.
Great. I appreciate talking about some of the collaborative effort through the other agencies. And another issue that we have with a lot of our regional banks, community banks as well, is the CRA, the Community Reinvestment Act, and it's being substantially updated. Do you believe that modernizing the CRA, do you foresee the Federal Reserve joining your fellow regulators in terms of that pursuit?
So we have been working really diligently with the OCC and the FDIC, and it would be my preferred outcome that we all find an approach that is responsive to the comments that we received on the OCC's ANPR and really does strengthen the ecosystem around CRA. I wouldn't want to do anything that would harm that ecosystem because I think our community banks, our community development organizations, our large banks, they all generally are really committed to the CRA and want to see it improved, but not disrupted in a kind of way that might lead to uncertainty about their ratings.
But I think we can certainly agree, though, uncertainty can create some real problems in terms of that compliance, in terms of some of the reviews that are going to be going on. You'd agree? Great. You know, I wanted to also follow up just a little bit, Governor Brainard, if we can, just in terms of the ability of some of our banks to be well capitalized. Do you agree with the Fed report that came out, substantially at least? Federal Reserve report stating that banks appear well positioned to exposures related to leverage banking.
So are you talking about the supervision report? Is
Yes.
that? Okay.
Gentleman's time has expired. I now recognize the gentlelady from California, the chair of the full committee, Maxine Waters, for 5 minutes.
Thank you very much, Mr. Chairman. This is a very, very important hearing that you have organized. Under the Trump administration, financial regulators have been advancing a number of deregulatory proposals rather than addressing financial stability concerns. For example, the Financial Stability Oversight Council, that is FSOC, plans to make it harder to designate large non-bank financial companies like AIG for enhanced oversight. In response, former Fed chairs Bernanke and Yellen, along with former Treasury Secretaries Geithner and Lew, warned, and I quote, "Through framed as procedural changes, these amendments amount to a substantial weakening of the post-crisis reforms. These changes would make it impossible to prevent the buildup of risk in financial institutions whose failure would threaten the stability of the system as a whole," end quote. Furthermore, additional concerns have been raised about weakening rules regarding capital, leverage, stress testing, and living wills for banks. These efforts, in the words of former Federal Reserve Governor Dan Tarullo, a kind of low-intensity deregulation consisting of an accumulation of non-headline grabbing changes and an opaque relaxation of supervisory rigor. Well, Mr. Chairman, as you know, I have said to some of our biggest banks and financial institutions that they had a big win with, I believe it was 2155. There was gross deregulation, and that I had asked them and even warned them not to come to the Financial Services Committee seeking other deregulatory efforts. And what has happened is there's an end run around this committee going straight to the regulators to do the bidding of those who are all focused on continuing to get deregulation in any shape or form. And I'm concerned about stress testing and living wills and capital and all of that. And so if this is an opportunity, rather than a question, to say to regulators, don't keep doing that. Don't keep being used to promote deregulation based on the fact that this committee has decided that we're going to do everything that we can to protect consumers. We're going to do everything that we can to stop the deregulation efforts of major institutions in this country that has been detriment to the people that we're serving. And so no matter how they frame it, the chair is not happy with what has been going on. And of course, in the event that this keeps up, we're going to have to deal with some legislation that would limit the ability for our deregulatory agencies to be able to do that. With that, I yield back the balance of my time.
Gentlelady yields back the balance of her time. I now recognize the gentleman from Texas, Mr. Williams, for 5 minutes.
Thank you, Mr. Chairman. And before I go into my questions, I just wanted to confirm something with both of you. This will be the 20th hearing that I have asked this question, and so far I have gotten the same answer from every single witness. Given both of your positions, I assume I know the answer, but I still must ask. Starting with you, Governor Brainard, are you a capitalist or are you a socialist?
Well, thank you for your question. I certainly have viewed markets that are well-regulated, that are competitive as providing really important benefits in terms of innovation and dynamism.
Well, are you a capitalist or socialist?
So again, I would say that markets that are well-regulated—
It's 20 to nothing right now.
Where we've seen strong competition, I
Okay.
certainly have seen important benefits.
Are you a capitalist or socialist?
Again, I
Okay.
don't really think
All right.
about it in those terms.
All right. Director Falcetti, are you a capitalist or are you a socialist?
Capitalist.
Okay, thank you. So when Dodd-Frank was signed into law, it created new agencies and departments that greatly expanded the reach of the federal government. During the previous administration, some of these entities drifted away from their core missions that were granted to them in Dodd-Frank. Well, some of the most serious examples of government overreach have come out of the CFPB. I'm still concerned about this practice in other areas of the government. So, Director Falcetti, can you please tell us the core mission that was granted to the Office of Financial Research in Dodd-Frank, and will you commit to working within these granted perimeters while you are the director?
Absolutely, sir. We have a narrow remit, and that narrow remit allows us to do very good work. We collect data to inform the FSOC, and we create research products to inform FSOC, period. And so that narrow remit lets us be a trusted advisor to the FSOC. We don't have people pulling us one way and the other way. It's data and research.
Okay. Secondly, I know we've touched on this briefly in the hearing already, but I think it's important to reiterate. There has been instability in the repo markets for over a week now. The Fed has injected $278 billion to meet liquidity needs of Wall Street. This is the first time that the Fed has had to intervene in the repo market since 2008. Sir Governor Brainard, what is causing this cash crunch in the short-term interest rate markets, and do you believe this to be an indicator of future financial instability?
Yeah, so thanks for the question. I think we are still making sure that we fully understand whether, in fact, there are some factors that we have not yet heard about. What we have heard about is an unexpected mismatch between the supply and demand, which would suggest that maybe we're in a period where reserves are more scarce than we intended, with our monetary policy framework being one of ample reserves. And so, among other things, it may simply suggest that it's time to allow the balance sheet to start growing again to supply the amount of reserves that the short-term funding markets are demanding.
In OFR's 2018 annual report, it states that the migration of IT systems from local servers to the cloud should be completed by 2019, which will ultimately save $2 million annually moving forward. I'm happy to see this modernization cost-saving efforts take place, but I'm always concerned about the cybersecurity implications. So, Director Falcetti, can you give us a status update on this initiative, the benefits you see from the transition, and how OFR will ensure that the data stored in this new system is protected from bad actors?
Yes, sir. We take cybersecurity very seriously, and the protection of our data very seriously. We collect data from our regulators, and we do so again with the goal of providing good research insights to the FSOC. And we take those data and we provide them to the FSOC. Now, every time that we collect a data set from one of the regulators, we have to protect that data at the level or higher than the protection that they give those data.
Okay, thank you, and I yield my time back.
Gentleman yields back. I recognize the Chairwoman Waters for a unanimous request.
Thank you very much, Mr. Chairman. I'd like to enter into a record a letter from myself and Sherry Brown relative to swaps margins, and then a press statement regarding FDIC's proposal to eliminate interaffiliate swaps. I'd appreciate entering into the record.
Without objection.
Thank you.
I now recognize the gentlewoman from Virginia, Mrs. Wexton, for 5 minutes.
Thank you, Mr. Chairman. Now, Director Falaschetti, you speak in your remarks a little bit about the history of the creation of OFR. In particular, you say that a prominent economist and former central banker eschewed calls for increased regulation of an already heavily regulated sector. Instead, he focused on opportunities for data analysis and monitors to increase transparency for inter-institution exposures and concentrations of risk in the financial system. Is that correct?
That is correct.
And thus, OFR was kind of created to advise the regulators about those risks. Is that correct?
That is correct. It was a sort of prescient call for the services that OFR actually delivers today.
Okay. And you speak a lot in your remarks about personnel and workforce issues, and I appreciate that, especially at a time when so many in the administration are targeting our civil servants. So I want to dig in a little bit more on this.
Sure.
Under Secretary Mnuchin, the Office of Financial Research was downsized significantly. Is that correct?
It was.
Okay. The 2017 budget estimated OFR would employ a full-time staff of 255 full-time employees. Is that correct?
I believe, I mean, that sounds right. I don't know that exact number.
Well, and the 2020 budget estimates OFR will only employ 145 full-time employees. Does that sound right to you?
That is correct.
Okay. So how many current full-time employees does OFR have at this time?
We have about 100 right now. Again, earlier, I'm not sure if you were on the dais yet, we are vigorously recruiting. We're, as we sit here today, the folks over at OFR right now are looking for our new IT director.
So that's about a 60% reduction from 255 to 100, is that correct? Doing the math.
Okay, well,
it's a pretty
I'll trust it.
Less than half.
It sounds right.
Okay.
Yes.
And I know that this report precedes you, but I took a look at it, and there doesn't seem to be any justification in here or any sort of footnoting of why such a drastic cut was necessary, even from 255 to 145. So can you explain the rationale behind gutting the OFR in this way or reducing the workforce in this way?
I do not. I wasn't there. It was well before I was confirmed. But I can make this commitment to this chamber today, is that the way Dodd-Frank works is that the director consults with the Treasury Secretary at the end of each year to reevaluate what resources we need, how's the office working, and you see in my opening statement, I'm very serious about the good work that our people do in that building and making sure that they have everything they need. I strongly agree with Mr. Meeks. I don't want to see 2008 again. I grew up in the south side of Chicago, the S&L crisis. I thought that was the worst thing in the world. I don't want to go through that again. When I taught money in banking, and S&L crisis it blew our undergraduates' heads open on how bad that was. We don't want to do that again. So I promise that I will ask for the resources that we need going forward.
And OFR is not taxpayer funded, though, is it?
It is not. It is not taxpayer funded. It is funded by an appropriation or from the large banks.
So, are you committing to this committee? Are you telling us here today that if you anticipate that you will need additional resources, you will go to the administration and advocate vociferously for those
Absolutely.
resources?
And we're about 100 strong as we sit here today. We are looking to expand to 150. When we get to 150, or when we start approaching 150, I should say, the 145, 150, we will reevaluate, see where we are, and make that determination then.
Okay. But as far as the reductions that you've seen so far, you don't have any analysis or study or anything like that which would justify the current staffing level. Is that correct?
Well, I'm unaware of how the one, again, it was well before I was confirmed that the 145 number, I wasn't in part of those conversations.
Okay. Thank you very much. I have no further questions. I'll yield back the remainder of my time.
Gentlelady yields back the balance of her time. I now recognize the gentleman from Georgia, Mr. Loudermilk, for 5 minutes.
Thank you, Mr. Chair. I do have some questions I would like to ask, but first of all, I want to follow up on something that my good friend, Mr. Lukemeyer, brought up regarding CECL and moving forward with an untested rule or regulation that could have significant impact on our nation, on our banking system, on our economy. I think it is imperative that we do some research and studies, and it seems like with several that we bring in, it's like banging your head against a brick wall. I don't understand what is the problem with looking into this before we launch it, and it seems that there is a lot of hesitation on that. So since we've covered CECL, I don't want to go down that path anymore, but I would hope, Governor Brainard, that you will encourage Chairman Powell and the FSOC to do exactly what we're talking about. For some reason, I don't know why, we want to rush forward with something that is unproven. All we're asking for is let's do a little bit more research on the economic impacts of CECL. So with that, I'll move on to something that, even though CECL is important, I still believe that the most dangerous, the most important issue facing our nation's economic system is cybersecurity. And it seems to be something that doesn't always rise to the top of the list of concerns. And because it is a significant impact on our financial system or a threat to our economy, it is a significant threat to every American business, to our government, to our military, to every individual. And I know that, Mr. Falcetti, you and I have had a recent conversation, and you told me that you thought that this is the biggest threat to our nation's financial system. And so could I get your thoughts on what you think need to be done to address this growing cybersecurity risk that we have?
Sure, and thank you for the question. I enjoyed our conversation. You noted that the long history that we've been studying this issue at the OFR. The first annual report that we published in 2012 evaluated this risk and put it at top of mind. Going forward, we're making progress. We have some really good researchers that look at network analysis. And so to bring some transparency to if your organization is subject to an attack, what other firms are connected to your organization, right, and how could that metastasize into something that could potentially be a systemic risk? And so this is a new monitoring tool that we're developing as we sit here today, and it'll really give us a lot more transparency to the nature and the magnitude of this risk.
There are two other elements that I think are important that don't seem to get a whole lot of attention. One, as I brought up to the Security Exchange Commission yesterday in discussing my grave concerns with the consolidated audit trail, is the base. I've spent 30 years in information technology, including intelligence in the Air Force, which we closely guarded, America's secrets, is you don't have to secure what you don't have. So unless you absolutely need the data, don't collect it, don't store it. And that's a concern that I have, and it doesn't seem to be something, we're in this age to where we would just want to obtain more data, then we're responsible for securing it. And my thought is if the government wasn't immune from lawsuits against them for data breaches, maybe they would think a little differently about not only obtaining the data, but requiring others to. The other aspect, the other part of that, which I'd like for you to briefly comment on, is the patchwork of conflicting state data security breach notifications. This is problematic. It leaves gaps in the system that those that we that are seeking to do harm can exploit. And I think that we need some type of uniform national standard that is flexible enough to keep up with technology. Mr. Falcetti, could you comment briefly on that?
Yeah, so on the data security, we don't collect data to collect data. That is the wrong way to do financial or literally any research. You have a question that you want to answer, and then you ask yourself, well, what data could help me address this question? So we're very careful about that process.
Gentleman's time has expired. I now recognize the gentlewoman from Michigan, Ms. Tlaib, for 5 minutes.
I'm sorry, Chairman. Lawson is, my colleague Lawson is always trying to distract me. Thank you so much. My district, and I'm not sure what others talked about, but I do want to talk about specifically my district, which is probably the most polluted district in the state of Michigan. We have some of the highest levels of asthma and respiratory issues among some of our residents, and dozens of polluting facilities that are hurting residents, like Dr. Dolores Leonard in my district and Emma Lockridge, who just recently testified at a field hearing in my district recently, this past couple of weeks ago. She constantly lives in fear that an explosion or toxic chemical could claim her life. She even went on to tell us in committee that she couldn't sleep without being interrupted with gagging and coughing due to the toxic smell fumes that enter her home. Emma is one of countless Americans fighting for their lives. So the financial institutions that continue to ignore the lives the lives that they are putting at stake with their fossil fuel investments, while just causing instability to our financial market, is a concern of mine. Many energy analysts see a significantly negative performance outlook for the fossil fuel industry in the coming years, particularly given the past decade of bankruptcies in the coal industry as the world transitions to clean energy sources. Yet financial institutions continue to invest in unstable fossil fuel companies that continue to expand their dirty energy production. So question is for Director, is it Falcetti? Is that?
Falcetti.
Falcetti, I'm so sorry. They mispronounce my name all the time. If there was a sudden urgency to sell off stranded fossil fuel assets, what impact would that have on our financial system?
Let's
Thank you.
assuming taking your assumption, I suspect having to do something at such large scale and so quickly could create some risks.
How would sudden urgency? How would such sudden urgency impact the shareholders and clients of financial institutions, which include pension funds that everyday Americans rely on for their retirement savings?
Right, and again, I'm taking your assumptions, and I haven't really.
Yeah, no, I'm not making this stuff up. It's actually happening.
Right, but the assumption that you're going to have this quick break, if that were to happen, sitting here today, I can't think about how that would not create some downstream effects.
Looking for a moment at the coal industry as the recent example, which went from king coal to widespread bankruptcy in the span of just a few years as the world transitioned to alternative and cheaper forms of energy, which were the financial entities hardest hit? Who took the losses?
I'm sorry, can you repeat that, please?
Looking for a moment, so basically when the coal industry, as a recent example, you saw bankruptcy, obviously, in the industry. Who was hit the most?
Right now, I don't know. I'd be happy to work with you and your staff to dig into this.
Okay. Two questions for, is it Brainard? Yes. Sorry. Most financial institutions continue to invest heavily in fossil fuels, as I talked about. Is your agency conducting stress testing for climate risk?
So I think the kinds of valuation impacts that you're talking about are important ones for us to understand. I will say that we have a variety of research that is being undertaken by economists at the Federal Reserve to think about what is the long-run impact on our economy from climate change, what could be the impact on our financial system. There's very interesting work that's being done internationally. I'm certainly in conversations with my colleagues at the Bank of England who are undertaking a stress test over the next 2 years of their financial systems to look at climate exposures. It's something certainly that I want to learn about and see whether it's something that we might want to look at. And we're actually hosting a conference out at our San Francisco Federal Reserve Bank in a few weeks on this set of issues.
No, I appreciate that. Thank you so much. Why are banks, my last question, and we can follow up, but why are banks and insurers and other financial institutions in Europe taking more an aggressive action on climate change than many of our U.S. counterparts?
We, in the annual report that I believe that you have from 2018, we do address the risk to financial system from climate.
Okay, thank you, Mr. Chair.
Gentlelady's yields back. I now recognize the gentleman from Virginia, Mr. Riggleman, for 5 minutes.
Thank you, Chairman. Appreciate it. Thank you for calling this hearing today, and thank you for both of our witnesses for being here today. Dr. Falaschetti, thank you for your service as the OFR director. While it might not be as well-known agency as the Federal Reserve, it is certainly important to maintaining and improving our robust economy. Thank you for that. As you are charged with the data collection and analyses that FSOC uses to make designation decisions, I would say that is a job we in Congress are appreciative that you are doing, so thank you for that. My first question for you is simple. Do you want to see the United States go through another financial crisis?
Absolutely not, and I think I mentioned that before, that you and I are of a similar age. We both remember the S&L crisis. We thought that was the worst that it could get, and it got worse still.
And I think you look younger than I do. And thank you, and I'm glad to hear that. And prior to your appointment, OFR had previously only had one director, is that correct?
That is correct. We had a confirmed director, and then we had an acting director in the interim period.
Okay, and as I understand it, under previous leadership, OFR had been criticized for taking a unilateral or one-dimensional approach to risk assessment that sometimes worked counterintuitive to your agency's mission. This was most explicit in OFR's 2013 Asset Management Report, which was widely criticized by individuals from varying political viewpoints as arbitrary, vague, and of little value. And by the way, I thank you for the 2018 report you sent me. I started to read it, and you're correct. It's a little bit easier. So here we go. What changes do you think can you make on your own, and what changes should Congress work on to ensure that you have the necessary but appropriate methods to execute your mission?
You know, we are subject to the oversight of Congress. That's why we're sitting here today. In terms of I'm sorry, you had a little bit more there, and I.
Right, and what I'm talking about is actually process. What do you think, as far as Congress, do you have the necessary but appropriate methods to execute your mission? When you're talking about your analysis, when we talked about a little bit earlier about what you're looking at as far as oversight, what changes should Congress make for you to help with methods to execute your mission?
I'm reluctant to opine on what Congress should do, having said on the other side of this dais previously. I am dedicated, and I know our staff are, to follow the rules that we are given and the mandates that we are given here. We will dutifully execute on those.
You know, and as far as your background, and I'd like to just ask you a couple of background questions, and I know we went through this before. What things have you done to make you qualified for this position right now, sir?
Sure. Well, I mentioned in my opening statement the President's 2006 economic report. I was at the Council of Economic Advisors at that time, co-authored a couple of chapters in that report, and we were thinking about how important the financial sector is to everyday Americans, and how systemic risks could really put a big dent into those opportunities. And we raised the flag, but as I mentioned in my opening statement, there were some really credible warnings about 2008, and for one reason or another, those flags were not chased down.
Thank you. And Governor Brainard, I also want to thank you for your amazing transparency, coming to see me and talking to me. You know where I stand on some things, so I do appreciate everything that you're doing. I had some questions here, and I want to talk about ubiquity, right? And there was something that I had read, and I do read a lot, talking about that the board, and we're talking about the Fed board, and we're going to talk about faster payments very quickly, and the FedNow service, and as that or a private sector service. In the November 2018 FRB notice, it stated that it is possible that the Reserve Bank entry could add to market fragmentation and lower the prospects for ubiquitous faster payments in the United States, especially in the short run. I know a lot of this is a conversation based on what we continued. I know we only have 20 seconds. So right now, so based on the Fed's own publication, admits that ubiquity will be chilled, especially in the short run. And it means thousands of institutions considering sign on to the private sector platform could be waiting to see how FedNow works, effectively cut off millions of consumers from real-time payments. That's something I'd like to follow you up on. I'm going to have to probably do questions for the record, so I apologize with that. So anyhow, I guess I have to yield my time, so I'll yield my time back to you, Chair.
Gentleman's time has expired. I now recognize the gentleman from Illinois, Mr. Garcia, for 5 minutes.
Thank you, Mr. Chairman, and I want to thank both of our witnesses here today. I'd like to talk a little bit about FSOC and shadow banks in my comments and questions. The 2008 financial crisis was a painful reminder that it is not just commercial banks that can make risky choices threatening the stability of our entire financial system. Hedge funds, insurance giants, and asset managers are all closely connected to basic financial stability. My constituents cannot afford another crash, so many of them are still recovering from the last one. Many people in my immediate neighborhood, throughout my congressional district, throughout the city of Chicago, lost their equity in their homes. They lost their jobs. Many became underemployed, and many had to double up in apartments, in homes throughout the area. Buildings became vacant throughout neighborhoods in Chicagoland. As a matter of fact, we had to establish a foreclosure mediation court in the county of Cook, in the metro area. People fell behind on utilities, car payments, there were more repossessions. Retail business strips had higher vacancy rates. There were empty storefronts throughout the commercial areas in the district. The informal economy increased as people took to the streets to peddle food, fruits, on and on. It was real pain. Yet during Secretary Mnuchin's tenure, the FSOC has voted to remove systemic risk designation from AIG and Prudential. FSOC has also voted to drop the appeal of the district court's decision in the MetLife lawsuit. Taken together, these decisions remove protections from non-bank financial companies with a combined $2 trillion in assets. There are no longer any non-banks designated as systemically important. I'm worried that we failed to learn the lessons of 2008 and are making the same mistakes. Large financial non-banks like Prudential and AIG were central to the last crisis. In fact, during the 2008 crash, AIG became the recipient of the largest government bailout in American history. Governor Brainard, do you think it is appropriate that Prudential, a company with over $800 billion in assets, has as its chief regulator the New Jersey Department of Banking and Insurance?
Well, thank you for your question. I certainly have traveled around your district and other places in the country where I think the effects of the foreclosure crisis are still evident. With regard to the designation authority under FSOC, personally, I thought it was a very important authority. I'm no longer close to it. I'm not the board's representative to the FSOC, so I can't speak to any particular decisions, but I certainly believe that non-bank activities were important and could be in the future important sources of systemic risk.
The Fed's Financial Stability Report warned that leveraged loans to corporations and noted that the, quote, more risky tranches are primarily held by asset managers, insurance companies, hedge funds, and structured credit funds. In light of these findings, do you really believe that there is not a single insurance company, asset management firm, hedge fund, finance company, or standalone investment bank whose failure could threaten financial stability today?
Well, I certainly would feel more confident if we had greater lines of sight into where some of those non-bank, non-supervised entity holdings are sitting, and that is why we supported work through the FSB, the Financial Stability Board, because of course this is an international market, to better understand where those holdings are sitting.
And on the subject of leverage loans, I will skip my introduction to the question. Let me cut to the chase, if I may. Do you think that it makes sense for Congress to act and restore risk retention for arrangers of CLOs?
So I think that issue is one for you in Congress to decide. I think risk retention has been shown to be an important risk mitigant.
Thank you. I yield back, Mr. Chair.
Gentleman's time has expired. I now recognize the gentleman from Missouri, who is Mr. Cleaver, who's also the chair of the Subcommittee on National Security, International Development, and Monetary Policy, for 5 minutes.
Thank you, Mr. Chairman. I'd like to find out from either of you, are you members of the Federalist Party or the Whigs or the Anti-Federalist Party?
No.
No.
It's critical to this hearing. But, you know, I just thought I needed to find out. We need to find out, you know, whether we have subversives, people with subversive opinions in here. So I'll get to the non-subversive stuff. I am wondering if there is a policy, Mr. Fallows-Chetty, that the OFR would, I mean, do you have a deadline for letters to be answered to members of Congress, particularly the committees of jurisdiction? Well, that's okay. I sent a letter on August 27th that I consider to be extremely important to me, asking for the information I sought. And I was actually a mayor of a large city, and we always said, get deadlines for the City Hall staff in Kansas City to respond to members of the council.
Right, and we are. This is we have received your letter, and it is being considered as we speak by our FSOC.
I appreciate it. Yeah, I appreciate you doing that. Here's the other issue: is I'm sure you believe that your role at the OFR is critical. I was here.
I agree.
During the last financial crisis, sitting right over here, and it was a tough time. Don't ever want to see that again. And so, with the value that I place in your department and the value that you do, I'm trying to understand why we would cut staff from the monitoring of systemic risk.
Per my previous testimony, it was well before my confirmation.
I didn't hear you do that.
I commit going forward to get the resources that we need to be effective. Your colleague just left. I grew up in South Chicago. I know what it's like to be underbanked. I take this job very seriously, and we have a fantastic team of employees back at the OFR who are watching us right now. They're doing great work, and I'm dedicated to fulfill the letter of the law here.
Well, I like your answer, sir, and I appreciate that. You know, it would seem to me, and that you didn't make the decision, but it would just seem to me that we're not, if there's any place we're going to have some economic leniency, it ought to be in the prevention of us repeating what happened in 2008. I was in here when Ben Bernanke and the whole gang and Cox, Sheila Bair walked in to tell us that that the financial system of this country was going down the drain by Monday. This was on a Friday. So I don't want to do that again, so I appreciate your answer. To both of you, as my time runs down, do you believe that financial regulators should be aggressive in regulating? I mean, for example, Facebook, should we wait until they come to an agency, or should we be aggressive and go and say, if you're getting ready to do something significant, run some kind of new program, some kind of product, do we wait until they do it? I have a letter from David Marcus, head of Calibra, and he doesn't want to launch this project until regulators have a look at it, and it appears that regulators are saying, well, we'll wait until Facebook comes to us, and it's just kind of confusing. Ms. Brainard, Mr. Falsetti, either of, yes, sir. Yes, ma'am.
Gentleman's time has expired. I thank the gentleman for his question. And now I'm going to recognize the ranking member for purposes of a 1-minute closing statement.
I just want to thank the chairman for having the hearing today. I think this is extremely important to our mission here, as he and I are the leaders of our parties, to be able to assess the threats to the system that we basically oversee, the financial services system, and the constituents that we serve, and the customers and consumers who take advantage of those services. You know, today we heard a lot of testimony with regards to, and a lot of questions with regards to what's going on, different threats. And there are a lot of threats to our system. Our changing financial services environment is under a threat constantly, and we appreciate your direct response to those questions. But obviously, you're going to have to continue to assess those threats in order to be able to thwart them. And there's two things I hope you continue to do. Number one, listen to and watch what's going on in the industries that you oversee, and commit to do the work of finding the solutions to get all the information and then act on it. Don't give me the Fed two-step. Act on what's going on. Don't give me a may, might, could, because after each one of those words I can say may not, might not, could not. I want you to be able to, don't couch those terms to defend your inaction, but I want you to take action when you need to. Recently, this past 2 or 3 weeks here, you've taken quick action to solve the liquidity problem in the markets. I commend you for that. But I brought up an issue today that I think is extremely important, that needs your action. I hope that you take those kind of actions. I appreciate you being here today, and we certainly will follow up and watch what goes on. Thank you. I yield back.
Thank you. I now recognize myself for 1 minute. Closing statements. Governor and Director, I recognize that the work that you do is especially complex, and the challenges faced in anticipating risk and crises have yet to manifest. As you've heard today, members of Congress from both sides of the aisle are genuinely concerned about repeating mistakes of the past. It is no exaggeration to say that our experience living through the financial crisis was traumatic, not only for us in government, but for the American public. The Fed and the OFR are meant to rise above politics and partisanship and focus truly on the financial stability and well-being of the American economy at large. Ultimately, every American family expects you and your organizations to take your responsibilities seriously, and I believe that you do, to approach them with intellectual honesty, rigor, and discipline, and to hold accountable those financial firms that have the potential to fundamentally disrupt our economy. and those of our economic partners. So please, I implore you to staff your organizations to the level needed to fulfill your missions, fight for the necessary budgets required to do your job well on behalf of the American families, and provide us with the data and information necessary to foster a strong, resilient, stable economy going forward. Again, thank you for your work and your admirable careers of public service. And my colleagues and I look forward to continuing to work with the both of you. I'd now like to thank again our witnesses for your testimony. And without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion into the record. This hearing is now adjourned. Good job. Thank you. Oh.